What's going on, everyone? Zachary Jensen here, managing partner of TaxWise Financial Services, where we're empowering small business owners with tax savings so they can grow with confidence. Today, we're going to understand the Augusta rule, a little bit of a background on the Augusta rule, how it works, and essentially how you can take rental income and make it tax-free. Now, there's a lot of kind of misinformation out there about this, and there's a lot of pitfalls we want to avoid. So let's just dive right into it and kind of separate the fact from the fiction here. Now, under the IRC code section 280A, where the Augusta rule is, it provides a very powerful but often misunderstood tax advantage for homeowners. This provision allows individuals to rent out their personal residence for up to 14 days each calendar year without needing to report that rental income to the IRS. It derives its name actually from Augusta, Georgia, where the homeowners traditionally rent out their houses during the Masters Golf Tournament. And while the Augusta rule can be an exciting tool for tax-free income, especially when used by business owners renting out their homes to their own companies, improper execution can easily lead to IRS scrutiny, denied deductions, or even penalties. So this article explores the mechanics of the Augusta rule, highlights common mistakes that lead to disqualification, and examines both failed and successful real-world applications based on actual tax court rulings. So we'll get into that, all that stuff. So how does it actually work? If you rent out your primary residence or any dwelling unit that you personally use for no more than 14 days per year, that rental income is excluded from your gross income. That means you legally do not need to report it or pay taxes on it, and you also do not have to allocate or deduct any related expenses. However, the moment you exceed that 14-day threshold, the entire arrangement becomes subject to typical rental income rules. You must report all the income, and you must only deduct expenses proportionally. This rule is particularly attractive to small business owners who have their companies rent out their homes for board meetings, strategic planning sessions, or off-site retreats. The business deducts the rental income while the homeowner excludes the income, creating a powerful tax arbitrage opportunity. But this only works if the arrangement meets IRS standards for documentation, purpose, and pricing. Here are a few common pitfalls that can trigger IRS disqualification for the Augusta rule. Number one is if you exceed the 14-day limit. That's pretty self-explanatory. Even if we do 15 days, that's going to lead to some problems. So we want to stay in that 14-day band. Unreasonable rental rates, right? So if you charge above market rental fees, especially in related to related party transactions, right? So your own business renting out your home, that can raise red flags. The IRS disqualifies the deduction if the rent is not in line with what an unrelated party would pay. The lack of documentation, right? So if you don't have a rental agreement, a corporate resolution, meeting agenda, or payment receipts, that can also lead to the IRS deeming the arrangement as lacking a legitimate business purpose. And that leads to the last one, no bona fide business use at all, right? So hosting social gatherings, family events, or vague planning days without defining an agenda or business objective does not qualify. The IRS is looking for a substantiated business necessity here. So it's very important that you do this. Here are some tax court cases where the Augusta rule failed. So there's a famous one in 2023, Sinope versus Commissioner. In this case, an S corporation attempted to use the Augusta rule by renting out their homes to the business for monthly meetings. Over 3 years, they claimed $290,000, crazy amount, in rental deductions while excluding the corresponding income. The IRS challenged both the rate charged and the legitimacy of the meetings, and the tax court allowed only 16,500 deductions, ruling that the taxpayer did not provide sufficient documentation or justification for the claimed expenses. So just to say that in English, right? They deducted 290,000, but were only allowed 16,000. So they got to pay taxes on the rest of that. So it's quite a hefty bill. And then we've got Jedhav versus Commissioner. I apologize if I'm not pronouncing that correctly. A married couple reorganized their chemical business as an S corporation and rented out their 4 residences to use it under the Augusta rule. The IRS successfully argued that the rental payments were unreasonable and likely disguised distributions. The court further denied the couple's attempt to estimate allowable expenses due to the lack of documentation and failure to provide the business necessity of meetings. So this case really underscores that simply renting your home to your business is not enough. You got to prove that the arrangement is legitimate, the price is fair, and the documentation is airtight. So here's how you do it properly. Because when you properly apply this rule, obviously you can create some significant tax savings. Taxpayers who succeed especially in tax court, tend to do these following best practices, right? So they charge fair market rent, the documentation and how they actually show it uses appraisals or quotes or even event spaces or local listings to show what a third party would pay. They establish a business purpose so to make sure the reason for the rental is legitimate. Examples include, shareholder meetings, tax planning sessions, company retreats. They back this up with calendar invites, agendas, minutes, and an attendee list. And they document everything, right? They create a rental agreement between themselves and the business. It's a written document. Both parties are signing it, even though it's you to you. And they ensure that the business actually makes the payments, ideally by check or ACH, and it's not something that they're just like kind of cash under their table. So a good example could be a business owner that hosts quarterly planning sessions at their home. They invite senior staff, pay themselves $2,000 per session based on whatever market they're in, and they keep records of the meeting agenda, minutes, and payment receipts. And then the use of the Augusta rule would likely survive any sort of IRS scrutiny if they were audited. So when you use this stuff properly, guys, you get a really, really nice tax deduction. However, taxpayers need to be cautious and stay within the 14-day limit, charge a reasonable rent, and provide strong documentation supporting the business purpose. The IRS and the tax courts are ruthless, and they've shown that they will deny deductions and impose penalties on folks if the standards are not met. So those that do it properly, though, get that nice tax benefit on the business deduction side as well as the tax-free income side on the personal. So really, really powerful and worth looking into. You just got to do it right. So we help a lot of our clients do a lot of these more advanced tax strategies properly so they don't get audited and they save all the money they're supposed to save the first time and for years moving forward. So if that sounds interesting to you, our contact is in the description below. Thanks so much for watching and have a great day.